Welcome back. My name is Chris Gosselin from Australian Fund Monitors. We're joined again by Renny, Ellis and Nicholas Chaplin to talk about the RBA's move, where they announced an increase in rates as broadly expected to 4.35%. Nicholas, let's start with you. What was your view?
Well, I think the expectation was that they would probably do this, and they've now eradicated or they've neutralised all of the three kind of wrong reductions in the cash rate last year. So we've got back to 4.35, and where to from here? You've got a evidently, if you look at the CPI outcome on the 29th of April, a few days ago, suggesting that the trimmed mean at 3.3% hadn't gone anywhere. That tells me that the statistical buffs are suggesting that still that the surge in energy costs and the knock-on effects to things like logistics and ultimately things that affect the household are temporary. So as I think I suggested in the video that we did in advance of the RBA call today, there needs to be an explanation as to, well, what do we call temporary? They raised rates last month, or last time the RBA board met, in a 5-4 vote on the basis that it was anticipatory of exactly what happened, and that is that core CPI was going to increase to 4.6. Now they've raised rates again on the promise that things could go higher. They're suggesting, Michelle Bullock has suggested that there could well be more to happen. And I'll talk about later on, once you've had a chat to Renny, that I think it's interesting that they are very seriously concerned with bringing CPI under control, which they should be, and yet they still keep tinkering around with a 0.25% rise. So whether it should have been done or not, and they've got to be thinking about the economic impacts of a 4.35 cash rate going forward, and potentially moving as high as, if they insist on doing 0.25, let's say it could be 4.85 before the end of the year, what that's going to do to the economy when they've already got pain coming through now from very realistic logistic cost increases. Will the government keep the excise discounts in place now going forward? Well, that impacts the budget. So a really interesting decision that has a lot of more questions than answers, I think, Chris.
Thanks, Nick. Renny, turning to you, what's your view?
I'm going to use the word transitory that you wouldn't dare touch, Nick. This energy shock, the impact on inflation should be viewed as transitory. They're prepared to look through these price increases previously and call them transitory. I don't quite understand why they weren't able to look through them now. The risk, though, it's not because of that risk about inflation. The reason they should have looked through it is that there still is a risk to growth here. We could well have fuel rationing of at least diesel in the next few weeks. They're going ahead of a budget, which is widely talked about to be increasing taxation on whoever, but if it is on the housing asset class, that could have big implications. I just think that they've made a decision in a period of ignorance. They should have been waiting for at least the June meeting. In all likelihood, this was the last increase this year, and maybe there might be one more. Well, if that's the case, then they still should have waited for June. They've had two. The implications of the two haven't come through yet on the economy. They should have waited until the June meeting and then moved then.
So, Renny, you're not expecting a recession, are you? Or does that depend on how long the oil shortage goes on for?
Yeah, if we get fuel rationing here of diesel, you can bet your house on a recession. We'll get hit very hard by fuel rationing.
The last time I saw fuel rationing was probably 1982 in Australia.
It was odd, wasn't it, Nick? It was odd cars and even cars, and
that's right. It was odd and evens day to day for about a week.
Yeah.
And what was going on in the economy at the time? There was a recession. So true to your word there, Renny, that the similarities are very interesting.
What's disappointing here is that the Reserve Bank is willing to risk a recession. Back in 2020, they threw everything in the kitchen sink, and so did the federal government, at preventing a recession occurring. And they were successful. And you ask themselves why they threw everything in the kitchen sink and risked that inflationary outcome that they eventually got. They did it because with our current household and government debt levels, we simply can't afford a recession. A recession would lead to a depression in this country. Household debt to income ratio, the highest in the history of the Western developed world. We are in a disastrous situation under a recession. But all of a sudden, Reserve Bank doesn't seem to be worried about that anymore. I don't understand where their thinking is coming here. The second thing is, what do they think they're going to achieve with higher interest rates? The currency is already very strong against the Japanese yen, very strong against the US dollar, strong against the euro. Where do they think the transition mechanism is going to come from monetary policy going into moving factors of production in the economy? It's not going to come from the exchange rate because the exchange rate's already there. So what impact is in higher rates going to have apart from depressing house prices and household spending? And is household spending going to fall? Not with government handouts, as been rumoured today. They're going to hand out $200 to $300 per income earner. So we're going to have an expansionary budget again.
Well, again, you mentioned before, they've done this just before a budget, which by all accounts is going to have some significant implications to housing and, as you say, to handouts. So they've certainly moved without full knowledge, one would assume, of what's going to happen next week.
I'm very worried. I mean, Nick mentioned earlier about them cutting rates last year. How are they not being questioned about why they did that now?
It's a really pertinent question that doesn't get asked after the rate decision and the governor comes out to speak for 45 minutes and interviewed by the media. No one is saying, you got it wrong last year, effectively, didn't you? Why did you do that? Cutting rates when the economy is actually very resilient at the moment. And it's, whether it be 2-speed, 3-speed or multi-speed. Over the last 40 years, 35 years, recession-proofing this economy has been driven, I feel, predominantly by the currency and by our resource exports. And when you look back and think about how the dollar, which has been down into the 50s whenever we've needed it to be, but as you drive interest rates forward going into the latter part of this year, that could drive our dollar to 80 cents. That's not going to help our ability to stay away from a recession when we've got a dollar materially above where it's been before, saving us from a technical recession at least. Meanwhile, you've got straight up pressure from what is happening with inflation. You've got straight up pressure with household budgets anyway, and the RBA is talking about maybe needing 2 more rate rises, which means that mortgages are going to go another 0.5% higher from here. So all of that is there to be taken. The RBA will defend themselves saying we've got a blunt instrument, we need fiscal assistance from the government. They're not going to get it through this budget that's coming.
I agree with everything you've said, but they didn't have this blunt instrument view in 23, 24 when they were raising rates slowly. They didn't raise them. They never achieved negative broad money growth like the ECB and the US did. Well, where was this blunt? It's a blunt instrument talk back then. They were boiling the frog very slowly back then too, and so unemployment. We remained beyond full employment through that whole period. The inflationary pressure was still there underlying in the economy. It's now the same pressure that they're talking about with private demand's too strong, and that's because unemployment's remained very very low and well below the 4.75% RBA estimate of full employment. Where do they think they're going with this? I really don't think that they've got much of a clue anymore. I'm sorry.
No, and it was interesting. It was an 8-1 vote too, so someone didn't agree with them. I presume someone linked to the government because no one wants rates going higher as you turn your mind to an election in the future. But the other interesting point, Chris, is that some of the banks have already come out, and probably because they've got to be prepared with an answer, and suggesting that rates will be reducing in 2027 FY, which is that's just pure crystal balling if ever I've seen it.
We could be in a situation, and we're not saying that while this interest rate increase, the last interest rate increase they shouldn't have done in the middle of an energy shock, it's not to say at all that they won't need to do more in the later half of this year into next year, because wages growth and with the Fair Working Commission minimum wage decision up shortly, the budget, which might be expansionary, and household spending still very strong, we may well have a problem that they have to address later. But at this stage, not the right timing.
Well, with things as they are in the Middle East, this could go on for some considerable time. So they're really looking into a very cloudy and murky crystal ball going ahead. Gentlemen, I hope you're not right with your outlook for the economy. I certainly hope you're not right with the outlook for a recession or, Nicholas, 4.85% cash rate. We'll wait and see, and we'll look forward to catching you in the not too distant future to see your opinion, possibly on the budget or the next RBA rate move. Thank you again for your time.
Thanks, Chris.
Thank you, Chris.